This is Viewpoints by Hennessy, a podcast featuring the latest thinking from the team at Hennessy Funds. Today, I'm speaking with David Rainey of the Hennessy Focus Fund. Let's jump right in. David, how are you approaching uncertainty around interest rates in this macro environment?
Well, Jay, there's always uncertainty around rates. We just accept that, and we don't base our investment decisions on rate forecasts either. Now, many of our holdings do use debt to help fund their businesses. And so we account for this when we underwrite the business. We look at a firm's gross and net debt. We look at its coverage ratios to make sure that a firm is never really flying too close to the sun. Because what we never want to be is exposed to the risk of a permanent loss of capital due to an over-levered business hitting a down pocket in the economy and being forced to do something that is detrimental to shareholders. All that said, lower rates will generally help the fund's holdings.
What impact are tariffs having on your investment selection process?
Really minimally. We don't have a material allocation to manufacturing firms that would be meaningfully impacted by rising tariff rates. For example, we do own a couple of specialty retailers. One's not really impacted, and the other, O'Reilly Automotive, is actually favorably impacted by rising tariffs. O'Reilly operates in an industry with rational competitors, and the company has think of it as the market power to pass on tariff cost inflation to their end consumers, which we believe should allow them to increase gross margin dollars, enhance operating leverage, and help expand their core earnings power. O'Reilly should be a long-term winner in our mind because it continues to take market share in the U.S., is expanding into Canada and Mexico, and it continues to optimize its balance sheet by issuing conservative amounts of debt to fund the return of capital to shareholders through buybacks. We really like its position in the industry, its management team, and its culture.
So, David, I want viewers and listeners to know we're recording this in the fall of 2025, and I'm curious how you think about the potential for a slowing U.S. economy or really even a recession, and how does it shape your portfolio positioning?
Sure. The likelihood of a slowdown today is much higher than it was at the beginning of the year. We're seeing flatlining new hiring, an increase in jobless claims, and inflation is picking up. But remember, economic volatility is always with us, whether it's interest rates, unemployment, nominal real wage growth, or inflation. We expect that over our average holding period, typically 5 to 10 years, that our businesses will be forced to deal with negative headwinds from both political and economic cycles. So we don't actively shape the fund in front of what might be a slowing economy or even economy speeding up. Instead, what we found over the last few decades, particularly in times of distress, is that exceptional businesses, the ones we're trying to own and hold in the portfolio, are generally able to take advantage of other people's distress, their competitors' distress and misfortunes in economic downturns through, call it select M&A, greenfield expansions, and or share buybacks. All the while, their competitors are forced to contract. So it's generally a place for us to see outperformance over time.
All right, let's dig into the Hennessy Focus Fund. So the fund holds roughly 20 names with 60 to 80% concentrated in the top 10. What gives you the conviction to run that level of concentration, and how do you manage the inevitable idiosyncratic risk?
Yeah, right, company-specific risk. Well, we've historically concentrated the fund's capital in the top 10 names because we think those are the ones with the best risk-adjusted return profiles and therefore should have the most capital allocated to them. We don't allocate capital by sectors or thematically. Instead, all of our holdings are evaluated on a bottoms-up basis for inclusion based upon what we call our 5 key investment criteria. These criteria drive our research process, and our decision making. Very simply, we seek to manage company-specific idiosyncratic risk by working to understand it. Our research process is, call it laser focused on what we believe are the key issues that will drive returns over the next decade. These 5 key criteria are: 1, the quality of the business and the returns on invested capital; 2, the quality of management. Are they good at operating the business and investing the firm's free cash flow? 3rd, what are the reinvestment opportunities over the next decade to grow growth in economic value for the firm? And then valuation, kind of a PE basis, horizon return basis, discounted cash flow. We use different techniques for different businesses. And then finally, our fifth item is this notion of tail risk. Is there something going on in the business that could permanently impair its valuation over time? Is there fat or fashion risk? Is there a lopsided balance sheet? And so what we find with so many investors focused on the next quarter or two, we find that there's simply less competition if your focus is out the next 2 to 10 years.
Excellent. So, David, you say that you target secular growth businesses with mid-teens earnings growth purchased at mid-teens or lower multiples. How
Right.
is that valuation discipline held up here in the markets recently?
We find the strategy continues to produce solid returns. Over time, if a manager's selection process is robust enough that they can find mid-teens or better compounders, then you should do better than the market over a full cycle. On top of that, if you can buy those names when they're trading at a discount to the market multiple, you also have the opportunity for multiple expansion over your holding period, which enhances returns. So we like both sides of that coin, if you will, and we're going to stick to our knitting.
Let's talk about your research process. What safeguards do you have in place to avoid confirmation bias, groupthink, or valuation blind spots when picking those 20-ish names?
Well, first, we have a team of 3 portfolio managers. I'm one of that team who work on every name. We research new opportunities individually and also together or collectively. There are no walled gardens here. We're all generalists. If 1 or 2 members of the team love an idea, oftentimes the 3rd member will play devil's advocate and try and pick the thesis apart. It's an iterative process. It starts with typically a shallow dive, and then maybe a medium dive, and then a deep dive. If we see as we peel the onion, if we see what's going on, remains very attractive to us. On top of this, because we run the fund fully invested, any new name must beat out a holding that's already there. So it's always a competitive process. And then excuse me again, you ask about blind spots. Well, there's what we found that there are certain sectors that for us are very difficult to invest in. Sectors like extraction-related industries, commodity industries, airlines, drug development, let's say, where PhD type insights are needed to pick winners and losers. So we try and work to stay within our circle of competence, which helps us, we believe, not get blindsided.
David, your fund has a heavy overweight to the communication services
Right.
sector. Is that intentional, and what's your thinking?
Intentional, no, but it's an outgrowth of our interest over the last several decades of all things wireless. And of course, our learnings in and around the industry from having owned a cell tower company that provides crucial infrastructure to wireless carriers. We recognize that there are 3 important trends that have been transforming the nature of communications over the last several decades. It's the transition from, call it, analog to digital, voice to data, and wireline to wireless. Our 3 communications holdings today are American Tower, Cogent Communications, and AST Space Mobile. American Tower provides wireless infrastructure through long-term leases through wireless carriers in the U.S. and globally. Cogent provides low-cost fiber optic data transport services globally. And we believe AST will be an emerging global compounder as well that's developing a cellular broadband network in LEO, or low Earth orbit, that takes advantages of developments in technology and the dramatic decline in launch costs to provide supplemental coverage to customers of terrestrial wireless networks.
Interesting. Let's wrap up with one more holding in your portfolio. Today, you own the Markel Group. What is the investment thesis behind this holding?
Well, Markel is a mid-cap specialty insurance company with important investments in public equities and control positions in private businesses. The company is often referred to as a little Berkshire Hathaway, which we believe is an apt comparison given their similar management philosophies and business mixes. In general, insurance is called a lower margin business with kind of an unattractive single-digit return on equity. But Markel, however, has generated returns in the low to mid-teens for many decades, and because of their strong and disciplined underwriting culture, their specialty market exposure, which gives them more customizable forms and pricing, as well as excellent returns from their public securities and their private equity investments. Over the last 2 years, Markel has been restructuring its exposure to what are the more volatile global insurance markets. And we believe that these changes, as well as the transition in the insurance leadership at Markel, should prove and result in lower volatility of underwriting results and higher and better risk selection, as well as lower expenses over time. Markel trades about 10.5 times our estimate of next year's change in book value per share, and we think that's a very attractive valuation for this unique business that should grow in the low to mid-teens going forward.
Excellent. Well, David, thank you so much for your time. Viewers, listeners, to learn more about Hennessy Funds, please visit hennessyfunds.com.
Thank you.